February 26, 1995. In a London boardroom, the directors of Barings Bank sign away everything. 233 years of history. The bank that helped double the size of the United States. The bank that helped bankroll the defeat of Napoleon. Sold to a Dutch rival for £1, not £1 million, £1, because the losses inside were so catastrophic that a pound was still overpaying. To understand how a bank that outlasted empires could be destroyed in a single afternoon, you have to go back roughly 3 years, to a trading floor in Singapore, a 28-year-old trader named Nick Leeson, and an error account with the number 8888. That account was supposed to be nothing, a place to file small clerical mistakes. Instead, it became the grave where Barings Bank was buried, one hidden trade at a time. Barings Bank was founded in London in 1762 by Francis Baring, the son of a German wool merchant who had settled in England a generation earlier. What Francis built was not a bank in the modern sense of branches and deposits. It was a merchant house, a firm that financed trade, underwrote risk, and moved money across oceans on the strength of its name alone. In the world of 18th and 19th century finance, a name like that was currency in itself. The defining moment came in 1802. The United States wanted to buy the Louisiana Territory from France, a deal that would double the size of the country overnight. The problem was that the young United States did not have the cash, and France, at war with Britain, badly needed it. Barings, working alongside the Dutch house Hope and Company, arranged the financing. British bankers, in effect, helped fund the war chest of the country trying to invade Britain, because business was business and the deal was too good to refuse. It is one of the strangest footnotes in financial history, a London bank quietly helping shape the map of North America. The firm's influence only grew from there. Barings helped finance the coalition efforts against Napoleon, profiting from the very conflict that had briefly complicated its American deal. By 1818, a French diplomat is said to have remarked that there were 6 great powers in Europe: Britain, France, Prussia, Austria, Russia, and the House of Baring. It was a joke with real teeth. A private bank, run by a handful of partners in London, was being spoken of in the same breath as empires. For the next century, Barings operated as a pillar of the British financial establishment. It financed governments, railways, and international trade. It survived wars, panics, and the ordinary churn of markets that destroyed lesser firms. It even survived its own near-death experience. In 1890, Barings had lent so heavily and so carelessly to Argentina that when Argentina's economy buckled, Barings was staring at collapse. The Bank of England organized a rescue fund with other London banks to save it, a bailout before the word was common. Barings survived, chastened, and rebuilt its reputation as a byword for caution and quiet competence. By the 20th century, Barings had become almost a national institution, a bank with royal clients, a name synonymous with old money and older judgment. It was the kind of place people trusted precisely because it felt immovable, a fixture of the financial landscape that had already proven in 1890 that it knew how to survive a crisis. That reputation, built over 2 centuries, would turn out to be exactly what let one young man in Singapore operate for years without anyone asking the right questions. Nobody imagined that the bank that had survived Napoleon and Argentina could be brought down by a single desk on the other side of the world. In the late 1980s, Barings sent a young man named Nick Leeson to Asia. He was ambitious, sharp with numbers, and good at making money look easy. By the early 1990s, he was running the bank's futures trading operation out of Singapore, placing bets on derivatives tied to the Japanese stock market. On paper, he was a rising star. In reality, he had been handed a structural flaw that no one at head office seemed to notice or chose not to. Leeson held 2 jobs at once. He was the floor's chief trader, the man placing the bets, and he was also head of settlements, the man responsible for checking those trades, reconciling the accounts, and reporting the results back to London. In any well-run trading operation, those two roles are kept firmly apart, because the whole point of settlement is to have someone independent verify what the trader claims happened. At Barings, in Singapore, the fox was also the guard. It is easy, looking back, to call this an obvious mistake. At the time, it looked like efficiency. Leeson was profitable, or appeared to be, and profitable people get less scrutiny, not more. London saw rising numbers coming out of Singapore and treated distance and success as reasons for confidence rather than caution. Nobody flew out to ask hard questions about how one man was managing both sides of the ledger. The mechanism that hid the truth was an account numbered 88888. Officially, it was meant to be an error account, a place to park minor booking mistakes before they were sorted out. Leeson began using it instead to bury losing trades that he did not want head office to see. A bad position could simply disappear into 88888, and because he controlled both the trading and the settlement functions, no one on the outside was cross-checking the account against reality. Losses that should have triggered alarms instead vanished into a ledger nobody was independently auditing. And rather than cutting his losses, Leeson doubled down. He began placing increasingly large, increasingly risky bets that the Japanese stock market, the Nikkei, would rise. Each time a position went against him, instead of closing it out and admitting the loss, he added to it, wagering that a rebound was coming that would make the whole problem disappear. For a while, markets cooperated. The Nikkei held roughly steady, and the hole in account 8888, while growing, stayed hidden beneath the surface of a bank that still believed it was watching one of its best performers. The bets were no longer modest hedges. They had become a wager on the entire future of the bank, made by one man, checked by no one, and getting bigger every week. On January 17, 1995, an earthquake struck the city of Kobe, Japan. It killed thousands of people and devastated the region. It also sent shockwaves through Japanese financial markets. The Nikkei index, the exact market Leeson had bet would climb, plunged instead. For Leeson, this was the nightmare scenario. His hidden positions in account 88888 had been built on the assumption that Japanese stocks would recover. Now they were falling hard, and every point the Nikkei dropped, his losses grew. Rather than surface the disaster, he did what he had always done. He pushed further in, placing even larger bets that the market would bounce back and rescue him. It didn't. The Nikkei kept falling, and the losses stopped being a hidden problem and became an uncontrollable one. By February 1995, the numbers inside account 88888 had reached roughly 827 million pounds, close to 1.4 billion US dollars. That was not just a large loss. It was, by some estimates, about twice the trading capital the entire bank had available. One man, on one desk in one branch office, had run up a bill that was bigger than the bank itself could absorb. On February 23, 1995, Leeson left Singapore. Behind him, he left a note. 3 words: "I am sorry." It is a strange, almost ordinary thing to write at the end of a story this large, and that plainness is part of what makes it land. There was no grand confession, no manifesto. Just an admission that something had gone terribly wrong and that he was leaving it behind for other people to face. Back in London, Barings executives scrambled to understand the scale of what had happened, and then scrambled to find anyone willing to save the bank. They looked for a rescue, the way the Bank of England had organized one back in 1890 after the Argentina crisis. This time, no rescue came together. The hole was too deep, the timeline too short, and the confidence that had sustained Barings for 233 years evaporated within days. On February 26, 1995, Barings Bank was declared insolvent. The following month, Leeson was arrested at Frankfurt Airport while trying to make his way back toward England. He was extradited to Singapore, tried, and sentenced to 6.5 years in prison for his role in the collapse. The Dutch bank ING stepped in and bought what remained of Barings for £1, taking on its liabilities along with its name and its history. A single trader, holding 2 jobs that should never have belonged to one person, had taken down an institution that had financed nations and helped decide the fate of continents. Barings Bank, as an independent institution, ceased to exist. The name survived only as a division inside ING, the Dutch bank that had bought it for a single £1. A firm that had financed the Louisiana Purchase and helped fund the war against Napoleon had ended up worth less than a cup of coffee. Its 233 years of history absorbed into a much younger foreign bank almost as an afterthought. Nick Leeson served roughly 4 years of his 6.5-year sentence in a Singapore prison before being released. He later wrote about what happened, gave interviews, and became an unlikely public figure, occasionally connected to sports management and speaking engagements. He is remembered less as a criminal mastermind than as a case study, the answer to a question every finance student eventually gets asked. What happens when the person placing the trades is also the person checking them? The collapse of Barings became one of the defining case studies in financial regulation. It is taught in business schools and cited in banking law as the textbook example of why the separation of duties matters, why the person taking risk and the person verifying that risk cannot be the same employee. Regulators pointed to Barings when tightening oversight of derivatives trading and internal controls across the industry. The lesson was not that markets are unpredictable, though the Kobe earthquake certainly was. The lesson was that an institution built over more than 2 centuries can be brought down by a single unmonitored point of failure if nobody is willing to check it. What makes the story endure is not just the size of the number, £827 million, or the speed of the fall, roughly 3 years from confident growth to insolvency. It is the contrast. A bank that had survived wars, a near collapse in 1890, and a century and a half of financial upheaval was undone not by an empire, not by a war, but by one 28-year-old given too much authority and too little supervision. The oldest institutions rarely fall because the world changes around them. More often they fall because somewhere inside them a very old, very simple rule got quietly ignored. Never let the person who places the bet be the one who marks their own scorecard.